Good afternoon and welcome to IPEM TV. I'm here with Ivan Vercoutère, Managing Partner at LGT Capital Partners. Welcome.
Hello, Rachel.
Hi. So, what's the biggest shift in private equity investor behavior you're seeing as we enter 2026?
So we're just coming off 3 years of so-so performance in private equity, and I get a lot of questions from investors about when does private equity get its mojo back. We haven't seen that in the past where private equity underperforms public equities for 3 years. So, with the 3-year data, a lot of CFOs and CIOs are questioning, what's happening to private equity and is it worth investing into given the performance of public markets over the last 3 years?
And with visibility across primaries, secondaries, and directs, how are relative risk-adjusted returns shifting as we look towards 2026?
So, a lot of investors talk about private equity as if it was one market. As you mentioned, there is primaries, secondaries, directs, but there is also small, mid-cap, large mega caps. And so one area that we like very much and continue to like is a small mid-market. We've always liked it. This is a segment that actually continues to do very well, even in this environment. So if you look at actually performance of the better managers in small mid-cap, it's been really good over the last few years. Distributions have been strong, returns have been strong. So we like that. Secondaries, we like it, but it's all about selection. Don't buy the market. That worked really well post-GFC. You could buy the market, use leverage, get great returns. This is all about stock picking. So you've got to pick your areas in secondaries, and pricing is extremely important. So we see areas of the secondaries market which is overpriced, and so we're looking for more the inefficiencies. And again, we like the mid-market focus there. A lot of investors are not able to invest in Asia. Executive order in the US, for example. For European investors, they know the market so well. It is a more difficult market, but if you know that market, and we've had a team on the ground for more than 20 years, we've been very active actually buying assets in China in the secondary basis. That's worked out very well for us. So again, selection, buy what you know and price it right.
Fantastic, thank you. And when you invest today with a 2030 to 2032 realization in mind, which themes or sectors give you the highest conviction and which are you more cautious on?
So to be perfectly frank, we don't have a crystal ball that goes to 2030. We don't even have one for 2026. And as Mark Twain would say, it's very difficult to make predictions, especially about the future. So, if you think about 2030, 2032, that's 5-6 years from now. One of the things we like in private equity, if you think about the low distribution yields over the last few years, essentially the duration of private equity has become longer duration, less liquid. That creates more uncertainty. That's also challenging for returns because you're compounding a multiple over a longer period of time. We actually like shorter durations. So we're not going to try to think about 2030, 2032. One thing we know about 2020, 2030, 2032 is that AI is going to have a big impact. What impact that's going to be, we don't know, nobody knows, but for sure it's going to be significant. Every time you've had a technological wave, you've had major impact on many industry and many segments of the market. AI will be one of them. You see it yesterday, correction in software stocks. You see the impact on credit, you see the impact on equity markets. I think that's just the beginning.
Beyond the well-discussed macro risks, what do you think is the most underappreciated threat to private equity performance as we go into 2026?
Well, look, we've come up subdued performance in private equity the last 3 years in the back of very strong equity markets. We've had 3 years of 20% plus returns in equities. That's quite extraordinary. By the way, we never had a fourth one, double digits. So one of the biggest risks probably is an equity market correction. If we have an equity market correction, I would say all bets are off for a market that will have exits, distributions pick up, and returns will be affected. The other risk we have is clearly a recessionary environment. One of the best things that happened the last few years is no recession, following the rapid rise in interest rates. And so I would say those are the two things we're looking at: how the public markets behave, what the credit market tells us. At the moment, we see a little bit of volatility. I think it's likely we have a 26 that's a little bit more volatile. It's not particularly bad for private equity, but it will create a new set of challenges potentially.
Fantastic. Ivan, thank you very much.
Thank you, Rachel.